Hello, it's Robert Miner with Dynamic Traders Group at this week's DT Trade Strategies video for the week beginning September 13th, where we take a look at one or two markets that may have a trade setup coming up. We explain the technical position of the market and a potential trade strategy. It's a short video, but if you like what you learn here, check out our DT reports where we do more comprehensive videos for our subscribers as well as updates every day on the various markets and trade strategies that we talk about. So let's take a look at the stock indexes this week. Well, this is the SPX weekly data, and there's two things we want to take a look at here. First, let's go down the bottom of the chart. Is last week the SPX made what we call a dual look-back momentum bear reversal. That's the first dual look-back momentum bear reversal in the 1321 lookbacks since the May weekly high back here several months ago. Now, after the May high, what happened? Well, essentially sideways for 3 to 4. It actually was about 5 weeks before we recovered where that reversal was made. Are we going to have the same thing, just sideways for 3 or 4 weeks, maybe 1 or 2 weeks down? Possibility, because the momentum reversal does not indicate necessarily, on its own at least, how important that reversal may be, other than it's a weekly reversal, which could go essentially sideways before it makes a momentum bull reversal. It could have a bear trend for several weeks. What it does tell us is for at least the next 2 to 3 weeks, the SPX and the other indexes as well are likely to be sideways to down. Then we have to look at other information to see how important that reversal may be. So let's go down to the smaller time frame, the next smaller, the daily. And we knew over the last couple, 3 weeks that the momentums, the weekly momentums, higher time frame were dual look back overbought. So we were basically on alert that a weekly high was close. So we would identify each week what is the reversal signal that a weekly high was complete. And our reversal signal this past week, let me put it on here. Actually, I've taken it off. I'll put it back on for our subscribers, was, as we came into the early part of last week, would be a daily close in the SPX below 45.2268. That would be the initial reversal signal that at least a daily high was complete. And then if the SPX should continue to decline and close below 44.7971, that was the August 16th closing high of this little swing high. That's what we call a closing overlap. That would indicate that a weekly high was complete. So we had the trading signal came on, I think this was on Tuesday, the day after the holiday last week, came on Tuesday, the close on Tuesday for a go short for a few days, and then the signal that more than likely we've completed a weekly high for at least 2 to 3 weeks came near the end of the week. It actually was on that big down day on Friday, and the close below 44.7971. So is that an immediate go short signal? No, trading strategies are really important, not just the technical signals that we get. So when this signal was made on Friday, the daily momentum was oversold. So typically, if we have a momentum indicator that cycles fairly regularly and fairly smoothly from overbought to oversold, if it's oversold, that's a warning we're near a daily low, and we should have a corrective rally lasting 3 to 5 days. So more than likely, sometime the early part of next week, we'll complete this daily low, and then we'll have a 3 to 5 day corrective rally, followed by continuation of the bear trend. And that's actually the best and safest time to enter a trade. W.D. Gann used to say the safest time to enter a trade is on the initial reaction against the new trend. Well, the new weekly bear trend, more than likely, we got it confirmed here on Friday on this new close. So now we can say the weekly trend is probably bearish. So we want to look for the first reaction against that new trend. And again, that would be the next daily momentum cycle and bear reversal, which more than likely it'll be late next week, maybe even the following week, before that cycle has been made. So you don't have to pick the top or the bottom. It's nice when we have a signal that's made very close to the top or bottom so that we can enter the trade with acceptable capital exposure, but it's no problem if you miss the initial reversal signal. What's important is that you identify the probabilities that the higher time frame trend has reversed, in this case the weekly trend, and then we wait for the first correction. In Elliott wave terms, we call that the wave B or wave 2 correction against the new trend to position in the direction of the new trend, in this case bearish. So that's what we're going to be looking for in the days ahead. So the lessons here is, number one, you identify if a market is reaching a position to make a higher time frame reversal, and then you go to the lower time frame to identify a specific reversal signal. And then once the specific reversal signal has been made, then you identify what we call a reversal confirmation signal. And if the confirmation signal has been made, then more than likely the higher time frame trend, in this case weekly, has made its reversal, and it would have a minimum, it's usually a minimum of 3 weeks in the opposite direction. So there's one other thing I want to show you related to the stock indexes that you might find interesting. This is the NASDAQ to cash weekly index from the March 2020 pandemic panic low. And for the first time in many weeks, even a few months, the NASDAQ is giving us the clearest picture of a potential 5-wave wave count, and that we're potentially near the end of wave 5 of 5. So let me explain a little bit what we got here and what we want to be looking for in the weeks ahead. Number one, coming up from that March low, we have 2 obvious divisions, in other words, 2 obvious corrections of higher time frame on the way up, and that's between the September high and the October low here. This is what we call a contracting or a running ABC correction, nice 3-section correction. That was much greater in time and price than anything prior, so that's a higher time frame. Then we had another consistent advance and another irregular ABC type of correction, followed by another consistent advance. So this is potentially a 1, 2, 3, 4, and a 5. So what's interesting here, why this has the potential for being a wave 5 and near the extreme of a potential wave 5, is that if we look up here, I've marked off what I got labeled as the 1 and the 3, and wave 1 advanced 83.69% and 246 points, and then the wave, what I've got labeled the wave 3, advanced much less in percentage change and range, just 26.64% and 182 points. And then if we consider this as a wave 5, it's coming close to the wave 3. It's been 21% and 160 points. So what's interesting here, if this is a 1, if this is a 3, because in Elliott wave terms, a wave 3 cannot be the shortest in price range of waves 1, 3, and 5, because it's shorter than wave 1, is that the wave 5 must be, if it's a wave 5 and if this is a wave 3, this wave 5 must be shorter than the wave 3. In other words, it must be less than 26.64% change and less than 182 points. Well, it's 160.84 points, 161 points. Basically, it's within 20 points of what the maximum can be for this to be a 1, 2, 3, and a 4, and for this to be a 5. So it's already made, NASDAQ cash already made a bear reversal, and this is on a what we call a momentum price divergence, which has been very typical condition as we approach a significant high. And that is, the momentum actually makes a bear reversal several weeks before the price makes its reversal. And what that simply represents is a slowing down in the rate of change of the price. So that's why the momentum can actually be bearish. The price can continue to be bullish, but it's just a slower rate of change. So of course the momentum, which basically is measuring rate of change, the momentum is less and less and less, so it's in a bearish trend. So it was also warning us of a potential top similar to what I've got labeled the wave 1 and the wave 3. So because it has the possibility of completing the trend for the March 2020 low, this is something just to be aware of at this time. It's not a forecast that that's correct, but we're going to be looking for in the weeks ahead, and this is going to be very important to identify early the signals that will confirm this is the end of a wave 5 coming up from the March low, because that'll have longer term, multi-month, if not a year or two, significance to the trends and position of the market. So that's what we'll be following up in the weeks ahead with our subscribers, is any initial confirmation, not only that this is a weekly high, but it's completed this section up from the May low. And if that's the case, that should complete the higher time frame 5-section trend from the March low. So it's going to be interesting to follow this in the weeks ahead. I wanted to bring that to your attention, so you might want to keep alert that the stock indexes are potentially making a multi-month, if not even a high that would last at least a year or two. We'll keep on top of that in our DT reports. I hope you'll join us with our DT reports. That said, take care. Have a fantastic week. Keep healthy, and be back with you next week with another short video.